The Moving Average Convergence Divergence (MACD) trading strategy is one of the most widely used technical indicators in the world of trading, and when applied correctly, it can indeed improve a trader's win rate by providing clear signals on potential market trends, momentum shifts, and entry or exit points. But to understand whether it can truly enhance your results, it is important to dive deeper into how it works and why it is considered reliable by both beginners and professionals. The MACD is based on the relationship between two moving averages, usually the 12-period and 26-period exponential moving averages, and the difference between them forms the MACD line, while a 9-period EMA called the signal line is plotted on top, and when these two lines interact, traders can interpret whether momentum is building up or weakening in the market. A crossover where the MACD line rises above the signal line is often taken as a bullish sign to buy, while a crossover below is a bearish signal to sell, and this simplicity makes MACD an attractive tool. Yet the real strength of the strategy lies in the fact that it does not only focus on crossovers, but also uses divergence, histogram analysis, and trend confirmation to generate signals that are more accurate than random guessing. For example, when the price of an asset is making higher highs, while the MACD histogram shows lower highs, this bearish divergence often warns of a potential reversal, and traders who act on such signals can avoid being trapped in false rallies, which contributes directly to an improved win rate by reducing losses from unexpected reversals. Another factor that makes MACD effective is its adaptability to different timeframes. So whether you are a day trader focusing on 5-minute charts or a swing trader analyzing daily or weekly charts, the MACD can still provide actionable insights, and this flexibility allows traders to refine their strategies across markets like forex, stocks, commodities, or even cryptocurrencies, making it a universal tool in trading. However, while MACD is useful, it should not be mistaken for a magic formula that guarantees profits, because the market is influenced by countless factors, including economic events, news, and trader psychology, which means relying solely on MACD without risk management can still lead to losses. Instead, using MACD in combination with other tools such as support and resistance levels, trend lines, or volume indicators often creates more robust setups that filter out false signals and enhance accuracy. In fact, many professional traders suggest that MACD works best in trending markets where price movement has a clear direction, while in choppy or sideways conditions, it may produce whipsaws that reduce a trader's win rate, so improving win rate with MACD is closely tied to the trader's ability to recognize market conditions and apply the strategy only when it is most suitable. Another aspect worth noting is that the MACD strategy is also highly dependent on discipline, patience, and consistency, because traders who impulsively enter or exit trades before signals are confirmed often end up reducing their chances of winning, while those who wait for clear crossovers, divergences, or strong histogram movements tend to achieve better results. When combined with proper stop-loss placement, position sizing, and risk-to-reward ratios, the MACD strategy can serve as a cornerstone of a trading plan that not only improves win rate, but also strengthens long-term profitability by reducing large drawdowns. Furthermore, traders who backtest their MACD strategies on historical data often discover patterns unique to the assets they trade, which allows them to refine their entry and exit rules and achieve higher accuracy, proving that while the MACD alone is powerful, its real potential emerges when it is adapted to specific market behavior. To sum up, the MACD trading strategy can indeed improve your win rate if it is used as part of a disciplined, well-rounded approach that combines technical analysis, risk management, and emotional control, as it provides clear momentum-based signals, works across multiple timeframes and markets, and helps traders anticipate reversals through divergence. But it requires patience, practice, and proper filtering to maximize its effectiveness and minimize false signals, meaning that while MACD can certainly tilt the odds in your favor, your win rate will ultimately depend on how consistently and wisely you implement it within the broader context of your trading system.